All right, it is Wednesday. At this point, you can sit back and relax. We've got Mike Giordano with Williams Wealth Management here. Money Mike, always good to see you. It's time for Mike on the Money. Today we're talking about the latest inflation report. All right, the smiles are going to go away for a little bit here. Today's report showed prices heading in the wrong direction, right. Mike. The Consumer Price Index indicated a 3% rise in the past year. That was higher than forecasters expected. So we've been living in a world of higher inflation for a few years now. Was today's data a big surprise to you?
Can I give you a wishy-washy answer? Is that
Go
fine?
for it.
You know, in some ways it was surprising, in other ways it wasn't. It was not as surprising given that we've had this big January effect. January is a time when companies feel like they can bump prices up a little bit. You know, it's the beginning of the new year. Like if we think we can push through a price increase, we'll do that. So there was some expectation you get some price increases there. It was surprising though, this number, because we've been hearing for months that we had all of these big prices at the beginning of last year in 2024. Those numbers are going to start rolling off. And so all of a sudden that should start bringing inflation down. We did not see that happen here today.
All right, seems like a lot of things we don't see happening, and then boom, they happen. So we want to try to understand, what does this mean for all of us as we're making those big money decisions? Will this keep interest rates elevated?
Yeah, it should keep interest rates elevated. The Federal Reserve has been telegraphing for months now that they are not in any kind of rush to try to lower interest rates. The economy has been holding up just fine. So it doesn't look like the Fed's going to be doing any kind of cutting anytime soon. And so if you're out there, home shopping season's coming up here, if you're looking for a new car, whatnot, you basically take a look at where the rates are today. And what the rates are today, they're probably going to stay in this kind of a range here for the foreseeable future.
And you talk about wishy-washy, we're up and down with inflation. So if we're talking about stocks and bonds, how does this play into that as well?
Yeah, so I mean, if you have the sticky inflation that's been hovering here in the threes, you're going to start seeing situations where it's the higher quality companies that are going to do better. So if you're thinking about your investments, you want to own higher quality companies that have good balance sheets, they're healthy companies. These are typically the larger companies. A lot of these companies are in the S&P 500. So that's kind of the places that are going to be a little bit better able to withstand stickier inflation, or if inflation rolls up. You also want to be on the bond side. We don't talk a lot about diversification with bonds as much as we do with stocks, but you want to be diversified on bonds as well, because you saw in like 2022 when interest rates were floating up pretty strongly, those long-term bonds, those 20 and 30-year treasury bonds, are selling off like tech stocks. And so if you, within the bond portion of your portfolio, you want to make sure you're diversified there. Diversified bond funds will hold short-term bonds, long-term bonds, so you'll be good and better insulated with that.
So I know for some people this will sound second nature. For others, this may sound like a foreign language. Yeah. So to put us all in the same group here, all of us on our investing journey, everyone's in a different place. Where do we go from here?
Investing journey. I like the way you put that. That is like a clever way of not saying older investors versus younger investors. But yeah, no, you're right. And honestly, it's not even comes down to age. It comes down to how far are you from a goal. So a 25-year-old might be 30, 35 years away from retirement, but they could be a year or two away from buying a house. And so you're going to be investing differently for those two different goals. But generally speaking, a 25-year-old who's looking to invest for retirement, they got $10,000 in their investment account, they're probably going to put more than $1 million into that account through all the money they're earning over the next 30, 35 years. So don't get too cute. Don't try to time anything. Just keep plowing money into the markets. Make sure you're diversified and make sure you have growth assets that are going to outpace inflation. If you're an older investor, you're the complete opposite side. You got $500, $1 million, $2 million in those investment accounts. Most of your money is now in the investment accounts because you're only going to be adding a little bit more the rest of the way. So those people need to be much more cognizant about what kind of investments they have, because if you invest the same way you did when you were younger, you're going to have this wide range of outcomes, and that's not the kind of stability you're looking for if you're heading into retirement.
All right, Mike G, the journey is different, but the journey is everything. Mike, thank you. We appreciate it.